to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth with Prof. M. I am your host, Mallory Meehan, and today I am joined by Grant Reaves. Grant, welcome to the show.
Thank you for having me, Mallory.
I'm really excited to talk about what you're working on because I think it's such a cool niche area, but I don't want to spoil it. So, Grant, why don't you introduce yourself, tell us a little bit about how you got into real estate, and then we'll start diving into exactly what you're working with.
Certainly. So our company is called Stoic Equity Partners. We're based in South Alabama, in a town called Fairhope, which is near Mobile, down on the Gulf Coast. My business partner and I started our firm in 2020, started really doing deals, though, in 21. We both came from commercial real estate brokerage prior to that. Jeremy, my business partner, focused mainly on triple net lease retail acquisitions and dispositions. I primarily did limited service hospitality throughout the country. So sold a lot of like Hampton Inns, Comfort Suites, Comfort Inns, that kind of product. But we'd always talked about getting on the principal side. So through COVID, obviously, brokerage slowed down a ton. And we kind of saw that as an opportunity to maybe start dipping our toes out and figuring out how to get, kind of the next step and start raising money and doing a deal. So started chasing deals in 2020, did our first deal in July 21. It was a self-storage conversion from a grocery store to a prior grocery store to a climate-controlled self-storage asset. We then went and did 3 more self-storage deals, a ground-up development, and then 2 acquisitions. But kind of that was, I guess, beginning of 22, we started to see that self-storage, especially on the Gulf Coast, there was huge amounts of population coming in through COVID and everything else that everyone was chasing it and everyone was building it. And really any asset class that you can build and sell for 10, 20% above replacement cost day one that you get the CO, that's a recipe to get overly saturated with product, right?
Yeah.
And so we saw that really happening in storage, and we always knew locally, especially, that the flex industrial space, which is what we do. So flex industrial, quick definition of that, just for people that don't know, is a multi-tenant industrial building. Usually about 50 to 150,000 square foot buildings, but they're made up of 2,500 to 7,500 square foot office warehouse suites inside of them. So it's kind of your typical business park kind of look that has kind of like an office look on the front and then a roll up or a dock high on the rear, and they have varying degrees of office to warehouse. But anyway, we knew that there was none of that product down here on the Gulf Coast. It's what every broker always talked about. They always had tons of tenants that needed space, and there really wasn't any available. We then started talking to more of our brokerage network throughout the Southeast and kind of found that to be the case throughout really the country, but especially in the Southeast, as you have population growing. A lot of the tenant mixes are going to be HVAC contractors or home builders or, home services kind of companies that need to be around population growth. And they need to be, in areas and there's more need where there's people moving. So we really dove head first in 2022 into that space, made our first acquisition, I guess, in September of 22 in Little Rock, Arkansas. Since then, we've bought another, 13 flex industrial assets throughout the Southeast. Our total portfolio is about 1.1 million square feet, and about 900,000 of that is multi-tenant flex industrial. So that's kind of what we do. We operate currently in, 6 states throughout the Southeast, and just looking to buy more and more flex that we can.
I love that. So I'm going to break some of what you said apart. And so
yeah, sorry, that was a lot. So
no, it was awesome. So you found this niche because you were working in commercial brokerage before, and you noticed that a lot of tenants, not necessarily your big Walmarts or Amazons, like the smaller players, needed more, customizable space that just wasn't on the market. And so most of who you have as tenants are going to be some of these like maybe mom and pop shops that, they're HVAC, maybe plumbing, maybe, landscape, art, like anything like that. Are you finding that you're getting any maybe more medium-sized tenants looking to kind of enter that space as well? Or is it still kind of the smaller end?
Yeah, so you kind of have a really interesting mix. So in our facilities, you'll have some international tenants that are publicly traded. Like we have Terminex in quite a few of ours, which is, a termite company. We have Tyson's Chicken, CVS Pharmacies, FedEx, UPS, Cone Elevators. There's some larger kind of international tenants. So we do have some larger ones. And then all the way down to, like you were saying, the mom and pop that maybe is, Bob's HVAC. And so it's kind of an interesting play there throughout, because we like to look at that because you have certain investors that look at commercial real estate and they just want credit tenants, right? So they just want FedEx or whatever the big player is. The issue we have with that is that FedEx will go out there and cancel, or not renew 50 leases. That's not a big deal to them. And, they have thousands of locations. That's not a big deal. That's just part of business. On the flip side, though, the mom and pops like Bob's HVAC company, well, Bob feeds his family off that office warehouse suite. So he has to have that location to be able to continue to live, right? And so it's kind of an interesting in between where you have credit tenants that are kind of your anchors, but you have these mom and pops that also are really sticky tenants as well. They're not really going out. If they go out, they're fully going out of business. It's not like they're moving somewhere else.
Right.
And so it's interesting to kind of have that blend. So yeah, our tenants, a lot of them are home services. We do also have, I feel like every flex deal has a CrossFit gym in it these days. So a lot of those technology companies that are in there. I'm trying to think what other tenant mix we have some life science space, like Tyson's Chicken does food testing for like food safety on their chicken packaging and things. A
Mhm.
couple of pharmacies that do like custom compound pharmacies that use the warehouse essentially as a laboratory. So yeah, it's an interesting place. You have a really broad amount of tenant base that you have, which is really nice.
Yeah, no, that's interesting. And I wonder, are you thinking about entering the data center markets? Because I know that that's probably one of the hottest markets that's coming up in 2025. And there was a growth of industrial space and warehouse
Mhm.
space. And, some the Amazons and the Walmarts were maybe overextending and now are
Mhm.
trying to cut back. Are you thinking that new acquisitions could potentially be targeted towards data centers?
Not really for us so much, just mainly we know our niche, and that's a really small bay kind of stuff. I mean, I do think that that's a viable play, and we do like to be near new data centers going in. We own a decent amount in the Jackson, Mississippi metro, which currently has multiple multi-billion-dollar data centers going into it. And so we like to be near those because those are large construction projects and they have a lot of contractors that need flex industrial space neither. So our play on that is to kind of be near where the data centers are going into, but not necessarily doing the data center deal itself. It's just a little bit different of a play than we do. Same reason we don't do the larger industrial stuff. I mean, it's definitely a very viable strategy. It's just kind of, stick to your lane and do what you do kind of thing. And we'll, again, want to be near them. Love to see them coming into our markets, but just want to be the small guy next door that can rent the contractor space, not necessarily the data center itself.
Yeah, no, that's actually a really good strategy to just kind of look at where data centers are going and
Hmm.
then look to see what opportunities you can then, explore around
Exactly.
where they are. Are there other key drivers for identifying a new investment location that you look at when you're making that decision?
Yeah, so a big thing that we look at is just general population growth in a market that maybe the total MSA is not necessarily growing in population. Maybe it's, we invest a decent amount in kind of secondary cities that maybe have a million and a half people in the MSA, and maybe that's kind of stagnant. But within that MSA, there will be little growth pockets of new housing, new retail going in. I mean, we always like to look if there's a new Publix or nice grocery store or new Chick-fil-A going in, like that's where you want to be, right? That's going to be a good area. It's going to have long-term growth. We like to be more near the more affluent neighborhoods, not necessarily off the beaten path and like a, random industrial park. We kind of like to be near the more affluent housing. And that's kind of going back into the mom and pop, HVAC conversation we were having that, whoever owns those small businesses or regional businesses, that's where they're going to live in that market. And they want their office warehouse to be near where they live. So you can get a little bit better rents by kind of co-locating next to them as well. So yeah, really population growth within the submarket is really the biggest thing, as well as just overall industrial growth, right? If we can be in a
Yeah.
park that has new Amazons going in, new FedEx distribution centers, the really big box stuff that we don't do, it's great to be kind of the ancillary small space to be the support system to the bigger boxes is what we
Yeah,
look at.
No, definitely. So, what I want to do is I want to have you walk us through how you would go about determining the value of a warehouse space. And so,
Mhm.
as you're going through that process, what sort of things are you looking at in order to determine exactly, how much maybe capital you have to raise, and then like maybe what you're anticipating doing rents. Are you going to do any capital improvements? Walk us through some of those kind of high level details that you're looking at before you're going to pull the trigger on a new location.
Yeah. So the biggest thing we want to do is we want to stabilize to double digit yield on cost. So year two or year three once we get it to market. So the first thing we look at is the price per square foot and market rents. So if we can get something for call it $85 a square foot and market rents are 10, that will stabilize to about 11 and a half yield on cost year two, year three. So that's kind of like the run of the mill, back of the napkin kind of math. The next thing that we're doing is we're looking at the actual in place leases to see how long they are. We want really short walls so that we can roll our tenant mix really quickly because what we're buying deals that always have under market rents. Usually they're 100% occupied, but they might have $6 rents in a market that's 10 to 12 at market. So that's what we're looking for. But we can't get into a situation where we're buying a deal that has $6 rents. All the tenants have 10 years left on their leases. There's no juice there because you can't roll those tenants.
Right.
Or if tenants have a lot of options, that's something that people don't really think about. But if someone has an option on your property for under market rent, then that's not good. You got to really watch out for that. So that's one of the
Because they're
biggest things
going
we
to
look
take that
at.
option.
Exactly, they're going to take that
They're going
option,
to
and
take
you're
it.
sitting there with the space for 12, and you're renting it
Yeah.
to this guy for 7. And so we always look for low walls, no option, very limited options, being able to stabilize to double digit yield on cost year two or year three. And then really just determining the market rent is a big deal. Knowing our markets is really important and knowing kind of what we've seen in different assets and talking to the brokerage community and knowing what you can get because there's not a ton of flux in some of these markets that's currently out there just kind of available. And it
Mhm.
is smaller suites. And so sometimes there's not the best data on CoStar or something like that just to go pull lease comp. So being able to really get your handle around what's actual market rents. So that's kind of the first step. The second step is actually looking at the physical asset itself and going into the CapEx piece. So a lot of CapEx that we usually do will be new roofs. These are usually 80s or 90s vintage stuff. They're getting to the point where they need a new TPO roof or new metal roof. Redoing parking lots, redoing landscaping, and then on the interiors, reducing office space. So we have bought a few assets that were lower occupancy, but the reason they were lower occupancy is that the vacant units were built out as maybe 80 or 90% office. And that's not what the market wants anymore, right? So they want more 50-50 or 60-40 warehouse office. And so we'll also go in there and kind of determine a renovation plan on the interiors where we can remove office to increase that warehouse ratio to be able to drive occupancy as well as rate at the same time. So yeah, overall, that's kind of how we're evaluating high level in each deal. But yeah, the biggest thing is what's your basis and what's your market rents and can you stabilize double digits? That's the biggest thing.
I think that's a great strategy. And my question would be if you are finding 100% occupied tenancy space
Mhm.
and let's say that a lot of these leases are maybe even month to month and they
Mhm.
can easily roll. Is it your strategy to try to then either have a conversation or understand whether that tenant is willing to come up to market, or are you going outside and trying to maybe pre-lease some of these spaces, knowing that they will become empty once the deal closes?
No, I mean, I would say that we probably have, I don't know the exact figure, but just kind of off the cuff, I would say we probably have 80% retention on deals that we're buying and pushing. The most tenants stay in place. So kind of how we like to strategize that is we like to start off by doing work on the property. If we're going to paint the exterior, we're going to put a new roof on. I just think that kind of shows good faith of like, hey, your rent's going up, but we are good landlords. We're going to improve the property as well and make it a nice place for you and your employees to come work every day. Because that's the biggest thing, right? And
Right.
I feel like sometimes people in industrial kind of forget that. They're like, oh, it's office warehouses. It doesn't really matter if it looks nice. Well, where people go spend 8-10 hours a day to make it look nice, you can get better rents. So it's just kind of a rule of thumb. So anyway, always like to start out doing some renovations, show good faith that like we're going to make it a nice asset. And then we most of our tenants will have maybe 1 or 2 year leases. And so as those start to come up, or if they're month to month, to your point, we'll start just having those conversations of like, hey, market's 12. That's where we're looking to go. You're currently paying, I'm making this up, but 650 triple net, we're going to 12 triple net. And usually how that conversation goes is they go, that's ridiculous, that's too expensive. And then they go look in the market. And if they can find anything, it's also 12. So it's kind of a situation where it's like, look, you can either pay us 12 and stay where you've been in business for 10 years, or you can pay 30 grand and go pay the other guy 12, but you're still going to pay 12 because that's the market.
Right.
And usually they stay for that reason. I mean, as long as it's a viable business, which most of them are, and they need a space, then we're not being predatory. We're not charging above market. We're just charging what market is. And so yeah, I mean, it's definitely a little bit of legwork for our leasing brokers. We do use third-party leasing brokers in each market that are local to that asset in that area. But I mean, overall, if you're, show good faith that you're going to do good to the property and people, a lot of people, it's also funny, they understand that they're well below market and you go and talk to them and they're like, oh, I knew this day was going to come. We're paying way too cheap. And you're like, yeah, we know. So
Yeah.
that is funny.
Here we are. We're about to,
Yeah,
bring
we're
it
here. Yeah, and they
up.
always see it whenever we go to tour our property. They kind of see us coming. They're like, "Oh no, my rent's going up," and I'm like,
Yeah.
"Sorry, but yeah, it is."
No, it makes total sense. So you mentioned that you're in six markets right now or six states.
6 states. We're in, I would say one, two, I guess 8 or 9 different markets.
Okay. Is there a
Mhm.
strategy on this market specifically, or is it just geographically close to where you physically are?
We like the Southeast just from the net migration that's happening down here. I mean, I just feel like that's a good tailwind to be able to ride. So we understand the Southeast. This is primarily where Jeremy and I's brokerage work was done. So I mean, we can go into I'm trying to Birmingham, Alabama. We're doing a deal up there. I did a lot of brokerage work in Birmingham. I understand those submarkets just from the brokerage world. So just kind of sticking to the areas that you know. Um, we do like to play in a little bit more of the stabilized markets rather than the really hot, high growth markets. Like we don't really look at Nashville. We don't really look at Charlotte, Orlando, South Florida, Austin, Texas, kind of like those big like COVID towns that just really exploded. And the
Hmm.
reason being is I feel like you're paying a little bit more for appreciation in those markets. You might be buying a 5 cap and you're not going to cash flow and then you're going to sell it again for a 5 cap and then you're going to drive back to a mid-teens IRR to your investors and that's fine and that's great and people have good success doing that. I would rather buy something that we can get to pretty good yield, say year 2, year 3, because then you get into a situation where let's say markets change, something's going on, you need to hold that asset longer than projected. Well, if you're still cash flowing 7, 8, 9, 10% a year, then that's not a bad asset to hold on to. Where it's a bad asset is when you're like just waiting for the sell to make all of your money. Then that kind of gets you a little bit behind the gun. So we like kind of more the secondaries that are a little bit more overseen. So maybe going into Memphis rather than Nashville or going into Birmingham, rather like a Charlotte or something like that. Not tertiary markets, not in the middle of nowhere. Still a million people live there. It's good, stable economies. But just a little bit less of the big blow up kind of towns.
Yeah, no, definitely. So you mentioned at your hold time. So tell me a
Mhm.
little bit about how you go about thinking how long you're going to hold an asset. Obviously, you could probably come in with a hold time in mind, and then,
Mhm.
different factors could change that. But with your investors investing, what kind of a time frame do you typically give them on, from start to finish on any given project?
Our typical is 5 years. That gives us, usually year one is going to be very low cash flow, just as you're rolling a lot of the rent roll, you're doing renovations, that kind of thing. And sometimes year two will be too, if the walt's maybe a little bit longer and takes a little bit more time to be able to work through that rent roll. And so that kind of gives us 5 years, gives us maybe 1 or 2 years of low cash flow. Then years 3, 4, and 5, you're distributing pretty well, and then exiting in year 5. We do have some deals that are a little bit more IRR driven that maybe we have a single investor that wants to go in with us. We're actually doing a couple of these right now where a single investor just really wants to turn money a little bit quicker. So those would be more 36 months kind of deals, 24 to 36 months to go in, a lot of month to month tenants, heavy value add really quickly and then flip out of them.
Mhm.
But our typical, like for our funds or a single asset raise that we're doing is usually a 5 year deal.
Okay. So let's move into your funds. And so, how
Yeah.
you structure your investments when you're going out and you're acquiring these properties. Give us some more information on how you structure that, what kind of, maybe overall returns your investors have
Mhm.
seen, and the types of people who you're maybe targeting to add as potential investment partners.
Yeah, so we're always looking for new equity investors that want to get involved in the flex industrial world. So we have A lot of accredited investors, that's just kind of your typical professionals that like to invest passively into commercial real estate, up into family offices, and well as institutions that invest with us. So kind of all along the kind of the equity paradigm there that people that come to us. Kind of our typical return structure is going to be maybe a 6 to 8% cash on cash average over 5 years with a 15 to 18%, maybe 19% IRR. There will be certain deals that are maybe lower cash on cash, but much higher IRR deals that are a lot heavier value add type of assets. Like we own one in the Atlanta Metro that I believe the projections were about a 4 to 5% cash on cash average, but the IRR was about a 20. But then flip side, we'll do some deals that are maybe 8.5% average cash on cash, and that starts year one. It's good cash flow, but it might only be a 14 or 15 IRR. So it's kind of two different sides of the pendulum. And that's mainly just because there's different investors that want different things. I feel like, especially on some of our younger clients that are a little bit more aggressive, they're not necessarily living off of cash flow. They kind of want the higher IRR, higher octane kind of deals, which are great. And then you have some people that may be a retiree that is living off dividends that
Mm.
wants to be able to put money to work and get quarterly distributions back to them. So that's how we do pay quarterly distributions. We raise equity. Usually we raise 90 to 95% of the equity, and then we bring in the remaining piece. We charge an acquisition fee, an asset management fee, and then we have a pref promote structure. That's usually an 8% pref with a 25 or 30% promote above that. So.
Okay.
Mhm.
So you don't use debt at all when
No,
you're
no, we do use that. Sorry, that's just on the
okay.
equity side. We
Got it.
definitely use
Okay.
that.
I
And
just
so we
I wanted
usually,
to clarify
sorry, I went over that. Yeah, so we usually put somewhere to the 60 to 70% loan to cost range on there. A lot of our debt is regional bank debt. A lot of our deals are maybe in that $7 to $10 million kind of range. That's kind of a sweet spot for a good regional southeastern bank that allows us to be able to get fixed rate debt, good proceeds. We do some deals that are more life insurance debt as well as CMBS, depending on their size and sophistication of the asset, and as well as how stabilized or not stabilized it is. So usually 60, 70% loan, fill the rest up with equity investors, then we put a piece in there. And yeah, that's how we put it together.
Love it. So I'm
Mhm.
really curious as to exactly how you decided that, going into syndications was going to be your next step after brokerage. And how did
Yeah.
you learn more about the whole process? Because I think a lot of people, they would love to get into something like this high level investing, but just have really no understanding of exactly how to structure it, legally, financially, all of the
Mhm.
disclosures. So give me an idea of how you went about understanding this whole process.
I've watched endless amount of hours on YouTube and read every book that I could find on it. That's really what it comes down to, because at the end of the day, like you mentioned, there's not really a solid roadmap for this kind of stuff. There are some online classes that are great classes, but I do feel like they're a little bit more institutionalized. That are maybe looking for more of the larger private equity shops for somebody who's just wanting to go. And then that's kind of the trajectory that we're on, is kind of doing larger and larger funds and getting more and more institutionalized. But there are people out there also that maybe just want to do a couple of syndications, be able to kind of use their network. And for that person, there's not a ton of education out there. I mean, there's YouTube, but there's also a certain level of, there's guys out there selling courses that maybe aren't doing it themselves. And so it's kind of hard to have to pick through the weeds and figure it out. But really that's what I did, is I read books, and I watched a lot of hours on the internet. I will say there's a couple of good books. One in particular I always like to plug when I can. I apologize, I'm gonna have to look it up because I can never remember the name of it, even though Investing in Real Estate Private Equity by Sean Cook. I don't know if you've ever read that book, but they give just a really good overview of, raising syndications or funds, or being on the principal side. So that's always one that I like to suggest people looking to get in the space. And then finding good attorneys. That's the biggest one, and figuring out someone who's done it before. Because that's
Mhm.
always the biggest thing with attorneys, is that you go to them and you're like, well, how does this work? And they're like, well, you can do it however you want. And it's like, well, how do most people do it? And so finding somebody who has worked in this space, that understands, like, hey, this is market, this is not market, is very valuable. To be able to have somebody that, say that you're you don't really know the typical fee structure or something, so you have an idea on how to charge a fee, and your attorney sees a lot of these deals, they can be like, hey, that fee is going to get pushed back because that's not market, because that's really what you're trying to do is make sure that you align with the market, right?
Yeah,
So yeah,
absolutely.
that's kind of my suggestions.
Yeah, I think that the attorney piece is really important, especially because, attorneys are general practitioners. And so
Hmm.
they are taught all about the law, but then, if you're only focusing on one thing, like if you're focusing on real estate, especially real estate syndications, real estate, assets, those are the attorneys that you really want to leverage in and lean in on. Because I know like me,
Especially the ones that have a securities background. I mean, there are certain people that I'll talk to and they're like, well, I have this really great real estate attorney. I'm like, I'm sure they're a great real estate attorney, but a transactional real estate attorney and someone who understands securities law and setting up Reg D offerings is not always the same thing.
yeah,
So sometimes you need two. Sometimes you
yeah.
need a securities guy and a real estate guy.
Yeah, absolutely. And I think also having a great accountant is
Hmm.
another, key player in the
For
mix
sure.
of teams. Okay, so if
I think that's
someone
true in every business, right? Just
Oh,
having a good accountant.
absolutely, absolutely. But I do like to point that out that,
For
the
sure.
attorney and the accountant are definitely needed for anybody getting into, I would say getting into real estate in general,
Yeah,
but
completely agree.
specifically, because you want to make sure that you're protected on your liability, you're
Hmm.
protected on the securities end, you're protected, on raising this fund and where the money is going and allocating, all the moving pieces. So,
Yeah.
do you use exclusively your network in order to try to find opportunities, or where are you maybe looking to find some of these new projects?
So we leverage a pretty good network of brokers throughout the Southeast. I mean, obviously, like we said, we came from brokerage, you came from brokerage, so I'm sure you can appreciate this. But what we kind of figured out only early on is there's other private equity companies like us that really try to go direct to owners a lot, and so might have even overseas cold callers that have letters going out, the dozens or hundreds of thousands, whatever. And that's a great strategy, but we kind of saw that like these brokers are already involved in these assets. And most of the markets we play in, there's anywhere from, I don't know, call it 2 to 10 guys who really work, or guys or gals that really work in the flex industrial space. So we would rather just go to those people and say, hey, here are the assets we would like to buy in your market. Do you know any of these owners? Can you call them for us? And that's such an easier sell rather than us trying to go out and make a relationship with the seller, prove that these guys from South Alabama are legit and all that. That takes months and months of conversations. But at the same time, if we already have a relationship with their leasing broker who can
Mhm.
kind of vouch for us, it just makes that conversation so much quicker. So we have a really great team of brokers that are out there scouring the earth for our finding us and feeding us deals. We fortunately have done a decently good job, I would say, of cementing ourselves as a flex buyer. I mean, we see a lot of deals way before they come to market, which is a great piece, right? And I think, I
Mhm.
mean, just for instance, I think I've gotten 6 deals this morning that were off already today. So I mean, we see a lot of deal flow. Primarily just because a lot of brokers know that, hey, if you have multi-tenant flex industrial value add in the Southeast, we are probably a pretty good buyer for you. And so yeah, it is much simpler for us. So we kind of see our brokers as an extension of our acquisition team, rather than me having to have 10 analysts out there burning up the phones. We can kind of sit back, talk to our brokers, make sure we're communicating well on what we want, what we need, and doing right by the brokers. But they're able to bring us a lot of assets, which is nice.
Yeah, I think that networking and making sure you have a strong connection with whatever
Yeah,
market that you're looking into is a key piece of any
yeah.
movement in real estate,
Well,
100%.
just as you and I both know that the best deals aren't on LoopNet. The best deals are done well before the internet sees them. And
Exactly.
so you got to know those players and you got to know the market you want to be in and be specific about what the market you want to be in and meet those players, and whether it's brokers or other owners. I mean, it's nice for us to know other owners because there are deals that maybe they need to roll out of because they have an LP that needs to cash out, but it's still a good deal and we can buy it from them. It's important to be in your market and know your players in your market for sure.
Absolutely. So, what does the next, let's say, 3 to 5 years look like for you? I'm just,
Yeah.
are you thinking that it's just going to be an expansion of this portfolio, or are you thinking about maybe adding some additional offerings? What does that look like?
Yeah, I mean, for right now, I mean, we really feel like we're in a good sweet spot in the small bay industrial flex industrial world. I mean, it's kind of interesting. When we first got into it, it was definitely very niche. It still is, but it does seem like every week there's new articles coming out about small bay industrial and how hot that market's getting. So we feel really fortunate that we got into it when we did and are just trying to scale up as fast as we can, just because I really feel like that wave is going to continue over the next 5 years. So currently, right now, we own about 105 million of assets. We have another 20 million under contract. We'll buy another, say, total, including that 20 million, about 75 to 100 this year. So we'll end the year about 175, 200. Other than that, we're just going to continue to add to the portfolio and expand out in flex industrial. I don't see us moving asset classes anytime soon. Every investment strategy has to be changed eventually, but we still see a very long runway. Really, until rental rates get to the point where you can build new product, I think that it has potential to get overbuilt at that point, just because there's a lot of people that are looking to build flex and they just get their development costs back and it doesn't make sense that they just shelve the project. But eventually, every year rents get higher and higher and higher. Eventually, it'll get to the point where people start building product. And when they do, that'll be great for us because I feel like the rising tide raises all ships. So like all rental rates will really explode at that point.
Yeah.
But also that's when you really got to start worrying about oversaturation. So I still think that's probably 10 years out, 5, 10 years out. But that's kind of long term, kind of how we see the space behaving.
Yeah, no, I completely agree. I think your assessment is on point. So Grant, how would somebody go about reaching out to you if they may
Yeah.
be interested in this space? Maybe they're looking to be a passive investor. How can they get in touch with you?
Yeah, so our website is Stoic, STOIC, EP.com. So it's Stoic and then EP for equitypartners.com. If you go into our team page, then I'm right there, and my personal number as well as my email are right there. Sending me an email is the easiest way to schedule a call, and always happy to talk to anybody, whether you're interested in being a passive investor or you're trying to become a deal sponsor yourself. Always happy to talk about commercial real estate with anybody. So.
Love that. Love that. That's great. So I know you had given us a book recommendation. Is there any other pieces of advice or, things that maybe you wish you would have known 5 years ago that you know now that you can give to new and aspiring real estate investors and potential brokers?
Um, I would say, trying to think of good antidotes. Stress test your underwriting really hard on your front end deals. I mean, your first deals, you're just trying to make deals work, and it's really great to be all optimistic and everything. But that's important. Know your downside risks, know where your models break, know where you have problems. Look at long-term rental projections, not just the past 6 months. I feel like some people just look at the current market and say, oh, well, multi-rates are $2,000 for a two-bedroom, so this pencils. What was it 10 years ago? How much has it grown? Is that just a blip in the radar? Or is that how it's been sustaining for a long time? What's your long-term real growth strategy look like? Because a market that has been at $1,500 for a two-bedroom and all of a sudden it's 2,000, probably don't want to underwrite 2,000. That could very easily go back to 17, 18. So I think that's the biggest thing is look at your long-term trends, really understand your numbers, make sure that you understand where a model breaks and give yourself some room to be wrong, because it's really easy to be a genius in Excel. That goes away in the real world. So
Absolutely. All right, Grant. Well, do you have social media or any other place that people can follow and see your
yeah, I'm on
content?
LinkedIn and try to be active on LinkedIn. I don't know my LinkedIn URL thing. I don't know if I have one, but just you can search Grant Reaves. It's GrantReaves on LinkedIn. And then email is the best way to get in touch with me as well.
Awesome. Again, thanks, Grant, for joining us. And that wraps it up for another episode of Inspire Wealth. I'm Prof M, out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.